I don't have it up here, but Dana's question, of course, is when, if ever, would you use a wide OTM naked strangle as opposed to an iron condor around an 85 to 90 delta? My personal answer is never. I haven't said this in a long time because we've been, covering different things. When the question comes up on iron butterflies, all call butterflies, all put butterflies, short straddles or short strangles, I am dead honest and say, I don't use them. I will likely never use them, personally. I don't like the idea. The butterflies, I see the risk reward, and then a butterfly is a little bit better. I don't want to trade anything with a peaked profit and loss chart, even if the upper to lower break even is pretty wide. I don't want to do anything that's naked. Okay, I don't want to do a naked call. And by the way, my broker considers this a naked call, which in this case, I'm not approved to do. I need level 4 trading to do it, Dana, so I'm not even approved to do the short strangle or the short straddle with the account I have my most money in. Okay, so I'm sorry, my answer is never. I will always stay with the iron condor if I was doing something neutral. If you go back through the webinars over the last year, you've heard me say that I, myself, and I don't think Ernie, has traded an iron condor position in about the last 5 or 6 years. Haven't even looked at it. Obviously, because it was in a nice bull run. I was just doing bull puts and making a killing with about an 89, 88% success rate over the last 5.5 years. Why try to risk the other side and have to keep managing it as they move up and move up and move up? It was a bull market, of course. So even though implied volatility right now is high, even though you can go to a delta or a probability of 85 to 90%, I am not comfortable in this volatile market with anything that has infinite risk to the upside, pretty much close to infinite risk to the downside. I'm just being honest. I will never do a short strangle position that is not covered in some way. Okay? All right. That's my direct answer, and I'm sorry that it's if you're looking for a specific thing. I understand that now would be the best time. Okay, I don't want to say now is the best time to do it at all. That's a misleading statement, and I apologize. Premium-wise, looking at implied volatility was 3 to 4 times its average for all optionable stocks, indexes, and ETFs. Now you'd say is the time to be selling. But of course, whenever you're selling, you're taking a direction, and we're in an extraordinarily volatile market where things can snap directionally very fast and cause large losses on the position. So with that being said, let me go back now, and it was James. James, Bob, and then I got another comment from James, question from James, a couple comments from Sam, and then looks like Binh has joined us as well. So he's got a comment. So that's the order I'm going in right now. For James first. Can you explain the risk in selling calls against an underlying you are down on, and should you do it? If your expectation is the market is still going to stay down, James, then you can consider it. Okay? Should you do it? It's risky, and here's why. Let's go to the portfolio here. Let me I forget my exact cost basis on this disastrous position. A disastrous position on the index, a married put. I'm down 24%, 23.4%, 991 from my purchase price of 42.29. Stock's at 32.38. Hey, this is a bulletproof position. I'm going to close it sometime this next week for a gain of about 3%, even though I'm down 23%. Okay. But if this was a covered call, let's say I'd lowered the cost a couple times. Let's say my cost basis is $40. What is the risk of selling a call in this case? And if you're tracking it in the portfolio, you'll see rollout opportunities, of course, that offer this. Well, the stock's down to $32. Let me go out at least 20 days. We'll go to April 24th expiration. What's the risk? See, there's no premium here. Oh, well, it's a gigantic bid-ask spread. It's unrealistic. Let's say we could get 80 cents here. There's no way I'm going to get $2 for this contract. Okay, so let's go to the 32.50. Let's say we get $1 even. Okay. Remember, my cost basis is 40. I'm going to lower it down to 39 with a 32.50 call. Right away, you see the risk. This is only 21 days out, but if things start to recover, I've locked myself into a losing position. This is very dangerous, and I know there's investors out there who teach that you can make 3 to 6% per month consistently with covered calls trading and annualize that, it's 100% per year. And then you ask them, well, what happens if the stock falls? He says, oh, don't worry if the stock falls. You can keep writing down and writing down. And then there's a recovery. You lock in a 16%, 17% loss, or you have to pay more. Let's say this jumps up to 36, 37. I've got to pay $5 or $6 to buy this back. What did that do? That puts my cost basis back up to 44. Now, if I sell at 38, I've got another $6 at risk, even though I get some premium. This is the risk of just saying, oh, you can roll down any time, just keep selling premium, keep selling premium. If I take this loss, if I get assigned for this loss, and I was making 3 to 4% on average, which is high, but in this market with the volatility, you see a lot of that, James. What did that do? That wiped out 4 to 5 previous trades. Okay? That wiped out the gains on 4 to 5 previous trades that I made that 3 to 4% on. That's the risk with doing it. You have to be careful. You have to give yourself some room so you don't do that. Here's a better idea. And I'm just going to lead you right to this, James. We talked about this last week as well. It's a great time. So that's the risk in selling calls against an underlying you're down on, and should you do it? You can consider it, but if you don't like it, there are alternatives. And one of those alternatives is just what we talked about a moment ago, but I didn't show an example. YNDX. Well, I'm going to click on stock repair, James. $40, 100 shares. There we go. Now, it made it all the way out to January. Okay, so what does this mean? This built me a ratio call spread, but it's out to January 2021. But my break even now is 35.38. It's 10% higher than the stock is now, but I don't need it to go back to 40, do I? That's the advantage of the stock repair. But I don't like this, right? It's all the way out to January. So depending on your position, is there another way that you can repair this? Here's the idea. Excuse me. I could, if I had the money, buy another 100 shares at 32 to average down. Right? This would put me at a cost basis of somewhere around 36.20, 36.40. Right? $4 up, $4, somewhere in that range. Oh, a little bit less maybe. It actually might be right, 35.90. But let's say 36.20. Now I average down. Oh, I'm sorry, James. My apologies. Do 200 shares. And now I have an August repair where I only need the stock to be back at 33.85 to get back to break even, not $40. Let's go to Analyze Trade. This will go, I'm just going to go to the profit and loss chart. But here's that ratio call spread I mentioned for Bernard. I have 200 shares now because I averaged down. I'm selling 34 calls at 245. It's going to bring in $900. And I'm buying 2 at 440. So I've got a covered call, 200 shares and 2 calls, and that bull call debit spread, I'm receiving at a credit of $100. Now, I don't see a lot of profit if it moves back above $33, but remember, my cost base is still $40, and I'm back to break even with a small profit in this case. All of that discussion and more is available for you on the webinars page. Just go to powerop.com/webinars.asp. Chat, there we go. I'll send this to everyone. We do this every webinar. I usually mention this one under the options concepts. Scroll down here, and from a few years back, manage your broken position, James. This is alternative methods for managing a stock position that has fallen in price, a covered call position that has moved against you, managing a sold put that's now ITM, and the stock has been put to you, focusing on the stock repair and other alternatives to the stock repair position rather than just rolling down and selling a call at that lower strike price. Okay, so there's some things you can consider there. It's a public page. Just go to powerop.com/webinars.asp, go to options concepts, manage your broken position. I'll give you some good ideas there on how to do them. Okay. Let me see if there's any comments on that, and then we'll go to Bob, and then we'll go to a couple of Sam's comments. Oh, you did. Oh, okay. Interesting. James says he did buy a June 80 to 120 call spread for the VIX for 80 cents this afternoon. Interesting. Let's see how that, I hope that works out well. Looks pretty good, actually. Just not looking at the graph here, just on thought principle. 80 to 120. Interesting. Very interesting. Okay. Bob says, last week you said if the conditions are right, you might put on numeric put just trades this week. Are the conditions right? I wasn't comfortable with it, and let me show you why. I had this up at the beginning of the screen. I try to show SPY weekly chart, Bob, at the beginning of the presentation. And let's see here. There we go. And I'm just going to go to 5 days. I'm going to go to hourly, okay? I was extraordinarily tempted looking at Monday. That's Monday there, going into Tuesday to consider it. And then some more things came out, and when I feel it's not right yet, I'm going to hesitate. Wednesday's open, tried to come back a little bit, and then we saw the slope down today. So we're getting fake outs here. Remember last week I talked about how we were starting to see the MACD crossover starting to look positive in that case when we were looking at a 3-month chart, but I didn't have the confidence that it was going to stay, and it turned out to be the same. If I open a married put, to be honest with you, Bob, I'm picking up shares of stocks right now. Sam even mentions this as well. Sam earlier on had mentioned, here it is. This is a time to buy beaten up stocks like Halliburton, Oxy, SLB, and CVX. He's looking at the oil stocks, the big ones that are likely to come back up when that gets settled. I've been sort of nibbling at shares of, this was from the webinar a couple weeks ago we had Navigating the Market. Ernie said he was nibbling at calls, leap calls, on large stocks such as Apple and other things that were a year to maybe 2 years out in time with this downturn. And if he's got the wrong timing and the market falls again, he's usually selling those and then rolling down to lower strike prices. I've been picking up small bits of shares on similar things, but like such as, Clorox, Costco, Gilead a little bit, and some others. If I did open a married put, the married put I would have felt safest with this week, and I didn't even see what it did. I was not paying attention to it, was potentially Kraft, because think about the money that they are getting in that case there. I don't want to say the money. Oh, that didn't work. I'm sorry. It's KFTR now, isn't it? Is that the new symbol, KFTR? I know, you're seeing just the SPY screen. Give me 1 second. Okay. All right, so we be back here, and this is the chart for KHC. This is one I'm considering. It's not in the IBD list, the normal search list that I use. Okay. This is one that I'm thinking not outside the box, but pays a good dividend, always has. It's a slow mover. But what is the one thing that everyone needs right now? Well, it's the staples. It's the grocery store foods. It's things of that nature. They had their earnings come out and they had that move. They're looking pretty strong right now. This might be something I would consider as a married put position. And you might see it on Monday. I can't guarantee it. This week, I missed an opportunity perhaps. We did see some movement, but here we were again 2 days ago down at the bottom, had that drop and started to move back up. So this might be one I may do as a married put. Probably go 8 to 10 months out in time, and I'll probably have a risk of 6 or 7%. If I'm feeling froggy, I may open it a different way to get sort of that synthetic straddle in play, so that if I'm wrong and it falls the wrong direction, I might still be at a profit. But this might be a peak, Death Valley once again, 12 to 15%. I'm not sure if I want to do that. I might do a married put on an inverse ETF. Sam talks about the contra ETFs. That's another thing I might do if I'm still concerned about more volatility, is doing the married put in that situation. But I haven't bought any yet. Those are my thoughts on what I'm looking at for Blueprint owners and for those following Infusion. I may get to them. I may not. Okay? All right. So this goes to Bernard's question, Mike, with the married put basically a bullish strategy and shorting stock having to own shares on the married call. Okay, hold on. I'm sorry. Is this a time to consider synthetic short married calls, i.e. the inverse of a married put, but inverse? If not, why not? I just answered that in a sense. Rather than do a married call where you end up borrowing shares of stock for your broker and you have to pay for that, which adds to the risk over time, continually adds to the risk over time. It's not something I like to do. Or trying to use the synthetic, I'll likely, if I'm feeling bearish, I will use a married put on an inverse ETF so I don't have to think backwards. all the income methods are the same, Bernard. If I'm in an inverse ETF and I buy a put on it and the stock moves up because the market's moving down, all of my income methods are exactly the same. If I do the inverse or try to do a synthetic inverse, what do I end up with? I have to start thinking backwards. Income method number one would now be selling an out-of-the-money put instead of selling an out-of-the-money call. I have to use the different structures to change my mind. I'd rather just buy an inverse ETF or maybe a 2x contra ETF as a married put position with a low risk, but it's probably still going to be 7-8% because of high implied volatility. But now I don't have to think backwards. That's how I play it in the bearish market as well. Okay, so that's what I look for, Bernard, in that case. So that was for Bob. And Bob, you'll probably see more on that. Fusion subscribers will see more on that next week as well. I just wasn't 100%. Okay. As always, Binh, you know my answer to this position, but we can take a look at some other ideas as well. And let's just go to the custom spreads. Binh says, Michael, I have a large Apple position which is still profitable. What is the best hedge? Okay, it's good. For me, it's a married put. Sorry, it's always going to be the married put is the best hedge. Not to complicate it, not to get confused with it. You have Apple, and let's say that you have profit is at 241. Let's say your cost basis on a couple hundred shares is 200 or maybe 180. We'll just say 200. What I'm likely doing is going out. October might be nice, but I want more time. So I'm going to go straight out to January. With this, they're going to be expensive, but here let's buy a 250 put. Might go higher, 260. I want 260, $41. Looks expensive, but remember you have a cost basis there of that. Let's just buy one, of course. So I know you have a bigger position, but that's fine. So here's a guaranteed profit in this case. If your cost basis is around 200, buying a 260 put right now out to January would cost $4,200, but you have a guaranteed profit of $1,700, 7.3% bulletproof position. That's the best hedge. Do we want to confuse it? Okay, now what also increases in value, what also gives us profit and protection in position if it falls? Well, we just spent a whole bunch of time on that ratio back spread. Would I confuse this and do a ratio back spread here by selling the 260 and maybe buying two 240s to try to get premium? No. But let's take a look. January. Thank you. Forgot which expiration I was in. So we go to the 240s. Let's see if that even works. No. That's 60. 215s. 210s. All right, what am I trying to do? I'm trying to still get a credit, right? So $42 here, going to spend about $38, $39 there. Okay. Is this a better way to protect the position because you're getting a credit up front? We're getting credit of $300. No, you're still taking a risk of 15%. Once it hits 210, you've got the risk there. A straight married put would be better than trying to complicate this with protecting your shares with a butterfly ratio put back spread or anything on those lines. The straight put, though it's expensive, this you're getting at a small credit to lower the cost basis, but because of the structure you need, you're not getting insurance to 210. By just buying the 260 put straight out, your bulletproof position, guaranteed 7.3% profit. Your numbers are different, I understand that, but you see the same example. Trying to complicate it and trying to get paid for insurance by doing these back spreads, ratio spreads, butterfly positions to add protection with payment means you're not getting the benefit you want. Now, I'm not saying Apple's going to drop to 210, but I'd rather be in a bulletproof position with a straight married put to begin with, still be able to sell premium and increase that bulletproof status over time, Binh. That's what I would look to do. And as always, just go under the married put tab, go to insurance, put in your stock symbol, your cost per share, and then you can select your different expirations. You wanted to compare it to what's available in December instead of January. Wasn't there a December? I thought there was. All right, let's just go back to January. Oh, I'm sorry. I'm sorry. I was way too far out. My apologies. There we go. So here, this shows me the locked-in profit that, you know, if I buy the 250 put, I'm still guaranteed for December a 6% return, bulletproof 6%. Here I'm at 7.8%. Still really, really good in that situation, okay? That is the best protection. in that case, Binh. Okay. All right. Sam says, I'm in PEP stocks holding well, Pepsi holding with well. PEP was at 119 and now it's back at 123. Need stocks like PEP. Okay. All right. So yeah, I think those kind of stocks there that, you know, it's always that question. Whenever an investor asks me, a power options user asks me, says, well, what kind of stock should I look at? What kind of stock should I buy? I reflect back when I first met Kurt Frankenberg, who wrote the blueprint. We partnered up with him. He's still a good friend of mine. Still talk to him on a regular basis. He still does consulting work with us. But Kurt had mentioned that, you know, it's like, well, what do you know? Well, I personally, I go out every day and I see a line around Starbucks. So that was one of his first radioactive trades because what you see leaving the shelves, what you see people buying. Sam had mentioned PEP. And, you know, what you see people investing in that are staples are going to be things that are likely, hopefully, to recover faster in the shorter term when things start to turn around. Now, I'm not making any projection of when things are going to start to turn around. I don't even like to talk about things turning around because our focus should be on, as Sam mentioned, keeping each other safe, keeping each other distant, keeping each other healthy, getting the good education and good trading ideas. But things will turn around. I don't want to speculate when. The main thing now is for everyone to stay safe and to stay healthy in that case. But, you know, Sam says Apple is a very volatile stock. It has range when the Dow drops, must be a consumer staple is what you're saying there as well. Okay, and that's why I like the hedge with it, Sam. That's why I'd like that married put there. Okay. Okay, this is a different James. This is a James K. I'm going to get to that in a moment. In that case, Sam, you also have 500 shares of SPXL. Wait, I'm just going to scroll through some of the other comments here. Okay, oh, the SPXL shares, okay. Okay, there's Bob's question. I'm just trying to make sure I've got through most of this here, and I think I have. Oh, and Sam, earlier you had mentioned buying BA at 125 for long-term, even a leap. Yeah, I think Ernie was actually looking at leaps on BA as one of those ones he had mentioned with Apple and others 1 year to 2 years out, nibbling on those call options that we talked about. Okay. Let's see here. James K. Different James. All right, James says, I have to scroll back and forth, James. I'm sorry. Sorry I joined the webinar late. No problem, James. I'm glad you made it in. I have seen your site for years, and I like what you're doing, but wondered what % on your money per year you feel like you can consistently make following your methods. Or maybe I'm asking what you are usually comfortable risking. With all of your adjustments on a bad trade, what is your win-loss ratio, your average % win, and your average % of loss? Well, I heavily tout, as you know, the radioactive trading techniques. We talk about the married put positions. Since 2007-ish, 2008, 50 to 60% of my portfolio is invested in the married put trades. And then, James, I also have been doing 10 to 15% in bull put credit spreads, which I stopped in February, thankfully. But at that time, you know, I was looking at around an 88% win rate on those positions and doing extraordinarily well. The last 5 years were a bull market. You almost couldn't miss with bull put credit spreads. You could, but we did exceptionally well in those cases. At times, I'll have 10 or 15% of my portfolio in addition to that in standard collars for protection on more volatile securities. And at other times, I may be doing diagonal spreads. Okay? So, different win-loss ratio in those scenarios. But to answer your question directly, I'm not showing my screen. My apologies. I logged on to my radioactive trading. Let's go to track record. Ernie's track record's here. My track record's here. I'm logged in as a user. So for the radioactive trading techniques, I typically see an average of 10 to 12% per year. Doesn't sound fantastic. Hold on one second. It's going through all of my trade history and loading the numbers there, James. Give me 1 second. Okay, there we go. My win ratio is 58% of the time with the radioactive trading techniques. Number of my total positions, 69 total positions since I started recording them here in 2008. I make an average 7% on my winners, 5% on the losers. Okay, that's my win-loss ratio. But I'm right 58% of the time. A year ago, not a year ago, 4 months ago, this was actually 60. I did take 2 losses on, there it is, NRG. And Dell, which I closed in January 2020. This got destroyed in the semiconductor market. Remember that in 2018 or the end of 2019? In that case, before all of this craze happened. The trade war killed the semiconductors, and Dell got destroyed with that, and then it came back, and then it fell again, and I couldn't keep up. And this energy stock, I just never had a successful trade with. But to answer your question, there's my average. Right there, mathematical. Everything I post for Fusion subscribers on Radioactive Trading with the Married Puts are my actual trades, and that's my win-loss ratio since 2008. I'm right 58% of the time. I make 7% when I'm right. If I started with $10,000 and you ran that simulation over 100 trades, this is what you'd expect to see at the end of that time frame. That's that resource tool we have there, the trade simulator. You plug in my numbers in the trade simulator starting with $10,000. This is what you'd expect to see. A low value of only 6% drawdown. That's pretty much realistic. Over time, over 100 trades, increasing the value by about fourfold, which is honestly, I started, what did I start with? I think it was $5,800 when I first started the radioactive trading positions. And through investing more money, putting more money in, and the profits I've been seeing, this is pretty close to what I've seen since 2008 in my personal portfolio. Okay? For this portion of my portfolio. I know it's not as sexy as a credit spread. It's not as sexy as a double ratio back spread. It's not as sexy as some other strategies, but the goal is consistent profit, forcing yourself into proper position sizing and ideal size trades as well. That's why I continue to use the married put position in my portfolio and have since 2008. It will always represent, even when I retire, hopefully very happily, but I will still be using radioactive trading techniques. I'm going to be trading my own account till well into my hopefully 70s and 80s, and married puts radioactive trades will still represent a large portion of my account. And then I'll have fun with the other smaller portions to emphasize proper position sizing. Okay, so I might let you answer to this one. Is that Ed? I'm sorry. Edison, I'm sorry. Edison, do you guys do a married put position that have wide bid-ask spreads? Well, pretty much everything has a wide bid-ask spread right now, Edison. So, and if so, how does it work when it comes to adjusting them, since you never know at what price you'll get filled? Seems difficult at this time. And I will let you know next week when I'm looking to open those married put positions that I had mentioned, maybe on craft or maybe on something else. 90% of the market condition times Edison, I have never had a problem getting filled at midpoint with my married put positions. Maybe 10 cents off of midpoint, 10 cents more than I'd want to pay above midpoint, but usually going out to the time frames, I do a couple strikes in the money depending on the stock price. I usually see a $1 to $2 bid-ask spread. I usually get right at midpoint without any problems. As I mentioned, I haven't opened a position yet during this time, so I haven't seen the effects of that and how much it's going to affect my positions, but I'll let you know Monday or Tuesday when I try to open that a couple new married put positions probably. I'm going to adjust my other ones first. I will tell you this. Before we got into the time frame, this was December 17th, there was news, there was still trade war news cycling, but news was starting to creep out about this coronavirus from China, COVID-19. My Fabrinet position, you can see here, I'm also down about another 14, 15%, 18% right now, okay? This one was 23, the Yandex, but that's a bulletproof trade. I'm going to adjust this one in this case. Now, when I bought this position, it was 64.33, and I bought the 70 put for 10.20. This was a little bit inflated in my opinion. Now, this isn't the actual trade. I've done an income method on this, knocked the cost basis down a little bit. But this, I tried. I don't remember the exact prices when I tried to open this, but I think the bid was 9 and the ask was 11.10. I was trying to get $10 even and it wouldn't fill. I moved it up to 10.10. It wouldn't fill. This is all during a course of about a 2-hour period. So I had to go up to 10.20. This was a high risk initially, higher than I normally like. I think it was 7.6 or 7.7%. Let's just go to profit and loss chart. Oh, 6.1. Okay, that's still not too bad on this situation. As I mentioned, I think I've lowered this down by $1.10, $1.20 cost basis for doing an income method. But in any case, that I wanted a better price on this and I didn't get it. But that's right, it would have been 5% if I would have gotten the midpoint I wanted. I had to give up a little bit more, but that was at the start. So right now, to be honest, I'm going to have to see, Edison, how it comes. Sam offers a comment, I've never had a problem as well in my contras. I do married put positions sometimes, and sometimes those 2 times or those single contra ETFs might have the 2 times, the leverage contras do have more volatility, wider bid-ask spread. But Sam has been able to get filled at midpoint. Ernie had a great experience talking about nibbling at those long calls during the market pullbacks on those big stocks. Boeing, Sam had mentioned, Apple. I think Ernie had even mentioned the oil stock Chevron as well. Sam, that's one that he was looking at also. He says he put in an order, the bid-ask spread for the leap. Oh, what was it? Was it C? It might have been Chevron. I can't remember. But he had about a 3.5 point bid-ask spread. He put it right in the middle, right at the midpoint to get the order filled for that leap call. Got filled instantly. No, didn't have to adjust it or anything. It filled right away. Okay. So there's a lot of market activity there that can get filled at the midpoints. Ernie's had some great experience last week. I didn't talk to him this week about his positions, but last week he was telling me that every order he put in on those leap calls got filled almost instantly at midpoint, even with the wide bid-ask spread. He was afraid he was going to have to haggle, go back in and adjust the price. It didn't, went right away. So that's something to consider as well. All right, well, ladies and gentlemen, I don't see any other questions. I think I might have accidentally deleted 1 or 2 of Sam's comments, but I think I got through all of them regarding these positions on SPXL, the contra ETS, of course, and I think I got to everyone's question. And, of course, I do apologize, Fernando, for not getting more into the description on management techniques on the ratio spreads. I'm saving that for a little bit later because it does get complicated, and because the structure's a little complicated, right? We're adding to the confusion in the better sense of the term there. And again, also want to remind Dana, thank you. He said no need to apologize there for that. But yeah, short strangles, butterfly positions, they're not my thing. I'll always be honest and upfront. I'm probably never going to trade them in my entire life, unless perhaps the short strangle's nested in a married put position where it's really a covered call with a naked put position. Maybe I do it in that fashion, but I'd never do it directly because I don't like the risk involved. All right. And Sam says, in Robinhood, they put you at the midpoint automatic. That's right. Okay, so I just wanted to go back here. I don't see any other comments or questions. Just want to remind everyone, of course, thank you for joining me today. Today's material are my thoughts and your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. I mentioned some things that Ernie mentioned to me that he's doing. I mentioned some positions I might be considering next week as a married put only, for that specific structure of a married put, would it be a synthetic long straddle. But again, I might change my mind next week based on what happens this weekend. We don't know what the market conditions are going to be. So anyway, I always have to be safe. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. Options involve risk, and we saw some of that in our examples today, but there's ways to hedge as well, but they may not be suitable for all investors. If you like some of the features that you saw today, of course, we worked with the custom spread, but we also took a great look at that long option finder for James's question about which put or call to buy or which puts to buy to help you with money. Well, plug it in, put in your expectation. You'll see the put that will give you the best bang for the buck if your expectations are met. We also discussed today the stock repair tool and the stock insurance tool for Binh's question on protecting the Apple shares. Those are all available, and anyone who wants to can get access to all those tools plus many more for 14 days. No credit card needed. Just go to powerup.com, put in your name and email address. You'll have full access to the 14-day free trial. Subscription levels after that start at $45 per month for end-of-day data. We also offer the 20-minute delayed data and the real-time data as well, depending on your needs and the strategies you're trading. Other free information, well, we shared that webinars link. There's a lot of free education there. We talked about the webinar on manage your broken position. We were talking about rolling down covered calls. Is it risky to go too low? And we saw a locked in loss there on that covered call position. You might want to take a look at that manage your broken position webinar for other ideas. Check out our recent videos we talked about. We reviewed some of today on the ratio spreads. I may not actually include that in the archives. I probably will, but I might not include it because that information's there on that sort of 20-minute, it's 19 minutes and 35 seconds webinar, new one that's up on YouTube called Introduction to Ratio Spreads. We covered 90% of the same material we covered today. Of course, you can always check out the blog as well for other education. Now, a reminder, no webinar next Friday, April 10th. The market will be closed for good Friday. So no webinar next week. But if you have questions, you can always send me an email anytime during the week. The other 4 days the market will be open to support@powerop.com or support@radioactivetrading.com. You can also call the office during market hours at 302-992-7971. And of course, trial members and subscribers, you can schedule a coaching session at any time. That's a 30 to 40 minute, 30 to 45 or however long you need, under an hour discussion with myself or Ernie. We'll walk you through the tools on the site, answer any questions that you have about investing like we do on the webinars, but it'll just be a one-on-one conversation as well. All right. Well, ladies and gentlemen, thank you all again. Have a safe weekend. Sam says, thank you, sir. Stay safe, everyone. Drink hot water with lemon juice to boost the immunity. I love to do that. I think I'll start off the day tomorrow actually with a Bloody Mary, to tell you the truth, because it's been that kind of week, and I want to enjoy the weekend. So we'll see. But yeah, won't be a warm Bloody Mary necessarily, but it will have the lemon, and it will have the lime, and it will have the tomato juice vitamins in it as well. So we'll start off our day with that tomorrow, as I look forward to cropping up this webinar for you. Randy says thank you. Thank you, Randy, as well. I hope you all enjoyed it today. Everyone stay safe and stay healthy. We will see you sometime next week, perhaps. We'll hear from you next week as well, and we'll see you soon.